Welcome students to the series of lecture for the preparation of CFA and FRM. And today we are continuing the session on currency. And today we'll discuss whether we need to hedge our currency risk or not in the space of forward contract. Yes, in the last session we discussed how to hedge the currency risk with the help of option contract. But today we're going to discuss how to hedge currency risk in the case of forward contract. Do we need to hedge or we should not hedge, right? So the decision to hedge in the forward contract or through the forward contract depends upon two important information. The first, what is the hedging cost? Do we have a hedging cost or not? And the main driver of the hedging cost is a roll yield. We'll discuss about the roll yield, but the first input, whether I need to hedge or not, is dependent upon the hedging cost. The second is risk aversion of the investor or the risk aversion of the portfolio manager. Now, if the person is risk neutral, he will only look whether the hedging cost is greater than unhedged cost of the portfolio or not, or if hedging cost is less than unhedged cost of the portfolio or not. And it will decide based on that cost analysis. If he feels and if he calculates, the risk neutral portfolio manager, the risk neutral investor, if he calculate that the hedging cost is going to be less than the unhedged cost, then definitely he will hedge because hedging cost is very less. Why not to hedge? But if hedging cost is very high, then he will go unhedged. He will not go into the forward contract to hedge. However, the risk aversion person is a dicey person. He would be in a confused state. And for that, we'll see that when a risk aversion person will decide that he has to hedge or not. Yes, it depends upon the conviction of the future prediction, but still it depends upon the risk aversion level. Okay, so first of all, risk aversion is something which we have discussed a lot in the portfolio management space. So we all understand what is risk aversion, but we have to understand what is hedging cost. And when I say hedging cost in the currency market, I'm trying to refer only to the cost associated to roll yield. Okay, roll yield cost of a hedging. That is what we are trying to discuss. Before jumping into the currency, because currency have price currency, base currency, which actually confuses student to understand the roll yield. So therefore, I'm taking a very simple asset, simple underlying asset, that is a stock, and based on the stock, we'll try to understand what is roll yield in a forward contract. Okay. So if you want to hedge your currency risk, your stock market fluctuation risk, your bond market fluctuation risk, the volatility, you enter into the forward contract. Right now, we are entering into a forward contract to hedge the volatility of an underlying asset, and that underlying asset is a stock. Now, we know that the forward contract could be in contango or backwardation. What is contango? What is contango? When the forward price is greater than spot price, we call it as a contango market. It's not important for us to remember this terminology of contango and backwardation. But please understand, whenever the forward price of the future contract or the forward contract is greater than the spot contract or spot market, we call it as contango. And if the forward price is less than the spot price, call it as backwardation. If the market is in contango, we will always prefer to sell in the future of forward contract, prefer to short the underlying asset in the future or the forward contract. Why? We'll discuss about it. If the market is in backwardation, when the forward price is less than the spot price, we always prefer to go long in the future or the forward contract. Why? We'll discuss about it. So let's see contango and backwardation. What is contango? When the forward price is greater than the spot price, so the forward price is 85 and spot price is what? 80. And we are assuming in the discussion of roll yield, and another name for roll yield is forward rate basis. In the discussion of forward rate basis or roll yield, that the spot market will remain unchanged. I know this is a stupid assumption, but we have to assume that in roll yield and the forward rate basis. That's it. The spot market is not going to change. So if the forward price is 85 and the spot is 80, we all know at the maturity of the forward contract, the spot price and the forward price will what? Converge. They will they will converge which means at the maturity, the forward price should be equal to spot. This will happen. Nobody can stop it. Inevitable, right? Now, if you have sold the forward contract, then what is happening? The forward price is declining, and at the maturity, it is equal to what? 80. Will you make profit or loss? Or have you made profit or loss? Profit, because you were selling the forward contract, you were betting on the downside movement, and that happened. You made a profit of 5 rupees. Why? Because in the market, the underlying asset is still trading at 80, and the forward contract has given you the obligation to sell it at 85. Awesome. You buy in the spot market and sell in the forward market. You made a profit of 5. So, in a very simple term, I made a profit or loss, and I'm writing it as FP minus spot price upon spot price. This is my profit and loss, and that is called as a roll yield. That's it. Currently, it is positive. Why it is positive? Because I have sold the forward contract. So the formula of the roll yield is not going to change. It is the modulus of FP minus S upon S. Absolute value of FP minus S upon S. FP, future price, S, spot price, S, spot price. That's it. But it will be positive. It will be positive. The roll yield would be positive when you are selling the forward contract if the forward is trading at premium or is in Contango. But if you buy the forward contract, see, if you buy the forward contract at 85, you bought it. So you have an obligation to buy the underlying asset in the future at 85. But in the future market, in the future, actual future, what is happening? The spot is trading. The underlying asset is trading at 80 only. So actually, you have to buy the underlying asset in the forward contract at 85. However, in the real market, in the spot market, it is only trading at 80. So you will buy at 85 and sell in the market at 80. You will make a loss of 5 minus 5 upon 80. Still, the formula remain the same. The only thing which is changing is what? Sign, positive, negative. So what do you have to remember? The roll yield formula is FP minus S upon S. It is not going to change. The sign is dependent upon whether you're buying or selling the forward contract. Okay. If the forward contract is in contango or premium, if you sell, then you will make a positive return, as in positive roll yield. If you buy the forward contract, it is going to be negative roll yield. Backwardation, this is going to be exactly opposite because the roll yield is not going to change even in the backwardation scenario. FP minus S naught upon S naught. That is the roll yield formula. FP minus S naught upon S naught and the absolute value. But in the backwardation, what we are saying, the spot is 80. The forward contract price is 75. And they will converge. We all know they will converge in the future. If they will converge in the future and the maturity, then FP is going to be equal to spot, that is 80. So if you buy the forward contract, then it is going to be a favorable decision for you because the 75 will rise and will become 80. Or you can say in the future, you're going to buy in the forward contract at 75 and sell in the spot market at 80. So if you buy the forward contract, you will have a positive roll yield. You will make a profit of 5. But if you sell the forward contract, if you entered as a seller of a forward contract, then you have an obligation to sell at 75 wherever in the market the underlying asset is only trading at 80. So what we have learned so far with the help of stock, not currency, that if forward price is greater than spot, then if you sell the forward contract, then roll yield would be positive. If the forward price is less than spot, and if you buy the forward contract, then the roll yield would be positive, and it would be negative in the just opposite scenario. Okay. So now we are entering into the currency market. In currency, we don't call it as contango and backwardation. We call it as forward premium when the forward is trading at a higher price than spot, and forward discount when the forward is trading lower than the spot. That's it. Okay. Everything is going to be exactly same. I'm just using the quotation because actually what happens when people deal with two currency in the quotation, they get confused. However, the principle of making a positive roll yield in hedging or negative roll yield in hedging in the forward contract is going to be identical what we discussed right now. So if you want to hedge and if the forward contract price is greater than spot, that is forward premium, or you can say that The quotation is INR upon USD. This is the price currency. This is the base currency is 85. And here the price currency upon base currency is 80 in the spot market. This is the spot market quote and this is the forward market quote. Whether it is trading at premium or discount. Premium. So what you will do? Will you sell USD or buy USD? The intuition should be that you will sell USD. Why? Because USD in the spot market is trading at 80. This is spot. And the forward market, it is trading at 85 INR. And we all know that we have to assume in the calculation of rolled yield or forward rate basis that the spot will not change. If it will not change, then it will converge. It will converge. And at the maturity, it is going to be equal to spot. So if you sell, you will make a profit. So that's what is written. If you need to sell, why I'm saying you need to sell in the currency forward contract, you have to decide whether to hedge or not. So if you need to sell in a hedging or to hedge your USD exposure, you have a USD exposure in the future. You're about to receive 1 million USD in future after 3 months. So what you will do, you will hedge. To hedge, what you will do, you will sell the USD contract. If you sell the USD contract in a forward premium scenario, in the forward contract, it will lead to a positive roll yield. But if you will buy the USD in the forward contract, it will lead to a negative roll yield. Formula is same FP minus S naught upon S naught. 85 minus 80 upon 80. The only thing will change whether the USD is trading at forward premium or forward discount. It is trading at forward premium. So if you'll sell, you'll make a profit because it will decline. And that will be in your favor because you're betting for the downside movement of USD because you're selling. Okay. If forward is less than spot, then we call it as forward discount in the currency market. So the example is the price upon base, which is INR, is the price currency, USD the base currency, and 75 is what? The quotation, it is the forward quote, INR upon USD, 80, this is the spot quote. Now, what will happen? This is the forward price. This is the spot price. We are assuming the spot will not change. So at the maturity, it will converge. If you buy something which is trading cheap, and if it converges to the spot which is 80, definitely you're going to make profit. And that's why I have said and written here that in hedging, if you have to hedge your USD exposure by buying USD in a forward contract, if it is in a forward discount, then you will make a positive roll yield because you're buying cheap and you're selling at a higher price. You're selling at a higher price and buying cheap again because you entered as what? Forward seller. Here we want to enter as a forward buyer. But to hedge, if to hedge in the forward premium, if to hedge, you need to buy USD in the forward premium scenario, then there would be a cost. What is the cost? The cost is negative roll yield. And if you need to sell USD in the forward contract in the scenario when the USD is trading at a forward discount, this will lead to a negative roll yield for hedging, and that is the cost. So, where are the costs? In these two scenarios, we have a cost. Now, listen very carefully because this is related to currency. If you are trying to hedge, and because of the forward discount or forward premium, you're going to have a positive roll yield. You will not think and you will enter into hedging. You don't have to think because the hedging is going to give you benefit. For example, the market is in forward premium and you need to sell USD in the forward contract. That will lead to positive roll yield. Why to think? You shouldn't think. You just enter into the hedging contract because there are two benefits. You're hedging and you're enjoying the positive roll yield. However, if the market is in forward premium and to hedge, you need to buy USD. You need to buy USD. That will lead to negative roll yield. Or if the market is in forward discount, you need to sell USD to hedge. That will lead to negative roll yield. That is the cost. And then, as an investor or a portfolio manager, you have to think whether to hedge or not. And that decision is based on if I hedge, for example, if you hedge here in this scenario, if you hedge 5 upon 80, 5 upon 80 is, let's do the calculation. You will incur a cost of 6.25%. In both the scenario, the cost would be, sorry, here the cost would be 6.25% because again it is minus 5 upon 80 itself, right? So this is the cost. 6.25% is the cost. Negative roll yield cost. When? If in the forward premium you buy the base currency, or if in the forward discount you sell the base currency. USD is the base currency in our discussion. The cost is 6.25. Now you have to compare. If you don't hedge, and that will only incur a cost of say 2%, negative 2%, you let it be unhedged position, and you will only incur a cost of negative 2%. Then you will decide what to hedge or not. To not hedge, what I'm saying, you don't hedge this position and you know that you will incur a loss in the future of negative 2%. You did some prediction. We'll solve a question. You did some prediction and you got to know that there would be a negative 2% of loss. If you keep your position of USD exposure unhedged, in this scenario, what you will do? Will you hedge or not hedge? Not hedge. Why? Because the cost of hedging is very, very high than cost of being unhedged. Okay. But this is only true for a risk neutral investor. Because how you said that it is going to be negative 2%? How you said that? Nobody has a crystal ball to see the future. It could be negative 20%. It could be negative 50%. You don't know in which way the USD and INR will move in the future. You don't know. So a risk averse person will always try to hedge until unless he has a firm conviction of the future prices. Okay. Now the question is, I'm just trying to connect to other concept. The question is why any currency will be traded at discount or premium. It only depends upon the interest rate differential, interest rate parity. Don't forget about the interest rate parity in currency. So if anyone is saying that, hey, USD will be trading at a discount or premium, you should think the only reason is the interest rate differential. Why USD generally trade at forward premium? Because we all know that interest rate in India or INR interest rate is always higher than the interest rate in USD. However, in any scenario, if you see that the USD is trading at discount, it can only happen if interest rate in USD become higher than the interest rate in INR. Otherwise, arbitrage will happen. Okay. Now, let's look into this question and try to think as a risk neutral and a risk averse person or investor or portfolio manager that whether you will hedge or not. So, an Indian importer or exporter will receive USD after 3 months. After 3 months, they will receive USD after 3 months. In the spot, USD is trading at 85. In the forward 3 month contract, USD is trading at 80. Okay. And you are receiving USD. Receiving USD. So to hedge, now think carefully. To hedge, will you buy USD in future or sell USD in future? You are about to receive USD in future. You will receive it. So you will sell it in the future to hedge at a fixed rate. And that fixed rate is 80. So to hedge, you will enter as a forward seller. This is clear. You will never buy USD if you're receiving USD. Why would you buy? Because if you're receiving USD, you will try to sell at a fixed price, and that is 80. Okay. So as a forward seller, you will try to enter into a 3 month forward contract, which is trading at 80. If you see this, you could have guessed that this is in discount. If this is in discount, this is in discount, definitely you're going to have a negative roll yield because this is the spot. This is the future. It will converge to spot. You should have bought USD, but because you have to hedge, you have to sell USD to hedge your exposure to USD. You cannot do anything about it. You have to enter as a seller. So there will be a negative rule yield. Fix negative rule yield. And the negative rule yield value would be 80 minus 85 upon 85. Okay, so minus 5 upon 85. So minus 5 upon 85, you also do the calculation. A negative 5.88% cost. This is your hedging cost. Now, there are two forecasts. One forecast is that Treasury, the Fed, is doing that after 3 months, USD will depreciate and will become 70. This is a forecast that USD will depreciate significantly and will reach to 70. However, JP Morgan is forecasting that after 3 months, the USD will appreciate and it will be 90. So the question is, will you hedge or will you not hedge? That's the question. So if you don't hedge, let's first solve for JP Morgan because it sounds realistic. So JP Morgan forecasting is that USD will appreciate and will become 90. So 90 minus 85 upon 85. So this is 5 upon 85. Again, it will come to 5.88%. So if you keep this contract unhedged, then you will make a profit of 5.88%. Because JP Morgan is saying that in the future, USD will appreciate after 3 months, and you're about to receive USD, which you will sell at 90 INR, not 85 or 80 or 70, 90 INR. Should you hedge or not? If, as a risk neutral investor, you will think, then you will simply say that I will not hedge because you're going to make profit by keeping your position open, right? However, if you're a averse person, risk averse person, 95% of the chance you will hedge because this is only a forecast. This is only a forecast. What if JP Morgan forecasting does not get validated in the future? Actually, it came to, say in the future, it came to 65. What you will do? Nobody is going to protect you because you haven't hedged your position. So risk averse investor generally hedge. They do not think about hedging cost. But it also depends upon what is the conviction of a risk averse person. If the conviction of the risk averse person is that yes, USD is going to appreciate and it is going to be 90, and I'm like 100% sure about it, then only they will keep this position as unhedged. Okay. So this was important. The second thing, the second scenario. Now where the treasury is forecasting that USD will fall to what? 70. If USD will fall to 70, so 70 minus 85 upon 85 upon 85. I think it is 15 upon 85, right? So 15 upon 85 is what? 17.647% negative. So minus 15 upon 85 will make 17.64% loss. That is a loss. 17.64%. That is the loss if you keep your position unhedged. However, in hedging, you're only incurring a cost of 5.88%. So why not to hedge? Why to incur such a huge loss and keep your position open and not hedge? 17.64% decline in this value, right? So this is the way people think about whether to hedge with the help of a forward contract or a future contract. Now, one important information, everywhere I have said forward contract. The reason is in the currency market, the dominant market is the forward contract market, not future. The reason is it's customized, it is available for any pair of currency, and most important, the volume and the liquidity in the forward contract is very high in the currency market. I know generally it is high in the future market for the stock, but in currency market, the forward contract volume, liquidity, everything is pretty high, and therefore people tend to go into the forward contract, not future contract. Okay. With that, I'll pause here. Thank you. Have a nice day.